And I think we all are much safer and would be much safer if the vaccination programs were much more successful, extensive in our part of the world. That's the low-income countries. And on the slide, you have a progress report of the vaccination programs around the world. And you can see Kenya towards the bottom there, something like 12% of our people have received either the first or partial, or for that matter, been fully vaccinated. So that's the point we wanted to make in terms of the COVID developments. But secondly, we also know, as we had discussed last time, the supply chain problems that were there, and these persist. And they continue to constrain production. They're pushing up prices, and therefore inflation in the advanced economies is well above the target bounds, the target bands. And in the US, for instance, the December inflation, CPI inflation, came in at 7%. And in the UK, December inflation was at 5.4%. In the OECD countries, inflation is on average the highest it's ever been in 25 years at 5.8 in November. And on the screen there, you have sort of the evolution of the various countries in the advanced economies. Now, concerns, of course, remain because of the prospect of wage price spirals, and indeed, inflation expectations may become unanchored. So this also ties in with the uncertainties about policy action policy actions by the authorities. In addition, in the US, there are concerns about the fiscal policy or stance of fiscal policies, and in particular their project to, or should we say their pushing the building better program, which has hit some headwinds in the approval process. But that's not the only thing. We also know that in China there has been a resurgence, or should we say, of infections, which has led to lockdowns. And also the other concerns, let's say vulnerabilities in the financial sector. All these put together have led to a downward revision by the IMF in their recent WIU update, a downward revision in the global, global outlook, scaling back growth in 2022. That's projected growth by about 0.5 percentage points. So now it is that global growth is projected at 4.4%. In 2022 from 4.9% last October. US growth is projected at 4%, which obviously has come down from what it was in October. And indeed, China now is projected to grow at 4.8%. In addition to this, of course, in the global scale of things, the price of oil remains a concern, and we have a projection there, or rather a chart that is showing the price of our, let's say, benchmark crude, which is the Murban crude oil, and you can see it's at $86.77 per barrel. Actually, as of yesterday, January 26, it went up to 88.67, which is an all-time high for this crude, Murban crude. So this remains a significant, let's say, wild card, significant risk, uncertainty, in addition to the geopolitical tensions that have emerged in recent months. So bottom line, in terms of the global outlook, it's weaker, but still strong. But there are high uncertainties. So uncertainties remain. Actually, they have increased. around a baseline that is still of strong growth. Moving on and coming back home to the Kenyan economy, we can talk a bit more about the external sector. And here we see that Kenya's external position remains strong and has strengthened during the pandemic. The exports, for instance, I'm waiting for the slides to catch up with me. The exports have increased by 11.7%. This is for the year 2021. And these obviously are sort of like the earliest numbers for the year. So we thank all those involved in bringing these numbers together this early. So exports have done very well. And I think you can see there, horticultures, for instance, horticultures grew by 18.9%. Manufactured goods also grew strongly at 33.4%. Coffee, though the number is small relative to tea, etc., the growth is quite impressive at 15.1%. Now, tea is a significant contributor to our BOP. And in this case, our exports of tea, the value of our exports fell by 2.7%. And I think this is in 2021 relative to 2020. And we explained this as that at the onset of the pandemic in 2020, there was an acceleration of imports of tea, because the importers in our destination countries, destination markets, were concerned about potential disruptions. And so they wanted, in a sense, to quote unquote stockpile them or advance or accelerate their imports. And so in effect, there was a significant increase in tea imports in 2020. And therefore in 2021, in a sense, there wasn't, they had already had these advanced imports. So now we are coming back to a more normal sort of pace, and Q4 actually confirms that. The exports of tea in Q4, there was some growth on that, which we have reported in the press release. On imports, we have imports increased by 25.4% in 2021 relative to 2020. And the drivers of that, I think, first and foremost, oil. There is another okay, maybe we only have this one. There was another one which I wanted to talk to, but oil exports increased by 59.4%. And this obviously was driven by the price. We already mentioned where the price of crude oil is. And manufactured goods also increased by 17%, chemicals by 20.4%, and intermediates. In this chart, we have consumer goods. And now I'm not sure whether this is for the entire year, but I had data for January to November. But in any event, consumer goods January to November increased by 20.1%. You can calculate what consumer good the growth is on this. And on capital goods, it was 12.2. You can calculate what it was for the year. But I think the one I wanted to mention is the intermediate goods excluding oil, which, as you can see, has grown quite sharply, which in a sense supports a sort of a robust manufacturing sector. So there has been significant recovery in the manufacturing sector, corroborated by the intermediate imports of intermediate goods excluding oil. Moving on to receipts for travel and transport-related services, these are picking up as the recovery continues. And for instance, on travel receipts, these are up by 46%, compared to a decline of 55%. Of course, this relates to arrivals, and you have a chart there that is showing the recovery that's going on with regard to arrivals or tourists, more generally speaking. Of course, we are still way away from the levels, say, in 2020 and early January, February 2021, before the 2020 before the onset of the pandemic. But you can see we have recovered, and in December, obviously the numbers have grown quite well. Transport receipts have also grown by 28%. And again, this relates to all the services that are being provided by, to the neighboring countries, etc. Then we have remittances, which is something that I think we have discussed before. And the inbound remittances were a record of 3.7, or you could say 3,718 million US dollars. It's there on the screen. And December was, from a point of view of months, December was a record month. And again, this is 20.2% growth against or relative to 2020, which itself was a significant growth over 2019. So it's amazing, in a sense, the contribution that we are getting from our remittances, or diaspora, as it were. As a side note, we did release a report of the survey that we did on the diaspora remittances, and that is available on our website and elsewhere. But I think it is important to remind you that we still are very much data-driven central bank. And so there's a lot of information here, and I have already seen some interesting sort of, people picking up some of the, let's say, the points that come out from the diaspora survey, the diaspora remittances survey. Now, bottom line on the external sector is that the current account has, on a preliminary basis, for 2021, is estimated at 5.4% of GDP. And it is important to, it's true, we had projected 5.2, so why the difference? Well, it's 0.2% of GDP, but I think the contribution here, or rather the difference, the error, if you want to call it that, is due to the forecast error, if you may, on the oil side, so the importation of oil. But in any event, as we have said before, our sweet spot for the current account is around 5%, and so this is exactly there. So we are okay with this. Obviously, this portends to stability and well-behaved foreign exchange market going forward, and also it supports what has happened so far. So in terms of the foreign exchange market, there are some charts that you can look at there. Yes. So this is the first one on exchange rates in the advanced economies, or should you say they are all obviously against the US dollar, right? US dollar. So you can see them in terms of their movements for the year. And it is clear that a lot of them, which pick them, they're there. You can see there was some depreciation. In a sense, this really relates to the strengthening of the US dollar for other reasons that we know. The economy was the expectation of a much stronger U.S. economy. Also, a lot of investments a lot of changes in the financial sector, etc. So that is the outcome. And then going to our own, let's say, selected African currencies, and you have all the way from the Zambian kwacha to Ethiopian birr. So you can see we are more or less in the middle. A depreciation, overall depreciation for the year 2021 of 3.6%. 3.6%. And as you also know, it's not only that there was just that 3.6% depreciation, which is, again, as I say, came out of the market developments. The markets were well behaved, and therefore there are no concerns about the performance of the shilling, or for that matter, the performance of the FX market. Reserves remain adequate, and we talked about 8.3 billion US dollars, the equivalent of that currently. Let's move on then to other aspects of domestic economy, so the real economy, as one would say. The thing to mention here is that we have had recent data from the Kenya National Bureau of Statistics, Q3 data for 2020. And also they have revised Q1 and Q2 data. In terms of the revisions, Q1, yes, there it is. So you have Q1 is now revised to 2% growth, and Q2 is now at 11.9%. Remember, that was 10.4% in the first print number. And Q3 now, the first numbers here are at 9.9%. I think we have gotten ahead of ourselves here, because now at least I'm showing you our projection. We'll come back to that in a minute. But I think the point I wanted to make is that we have had the revised numbers. We've received the revised numbers. We've also looked at our leading indicators, and all of them point to a strong recovery, or confirm a strong recovery in 2021, and expect a continuation of that strong performance into 2022. But let's go through some of the numbers. First, on services, you can see that there's a strong recovery in services. The slide before, please. Overall growth of 10.8 after the decline that we had in 2020, right? So we have it there. 10.8 compared to the decline of minus 2.2% in 2020. And in this, I think the exception which you see there is accommodation and restaurant, still showing a decline in 2021. However, as you can see, if you pull it out into in the quarters, you'll see that the recovery started in Q2 and Q3. And we expect also that recovery has been sustained in Q4, and we will talk about that when we discuss, let's say, the survey of hotels. So that, I think, is something that collaborates or supports the conclusion of a strong recovery in 2021. Now, there are some leading indicators that I want to mention. Maybe, we have the turnovers. We can go very quickly through them. And here we have turnovers from manufacturing and wholesale, retail, wholesale and retail trade. And you can see the growth in terms of the turnovers. That's the red numbers, but the growth are the green bars. And you can see that they have had robust growth. And this is the manufacturing sector. Again, we are talking of other indicators, the imports on intermediate, and we'll show you in a minute credit for this sector. Then you have wholesale trade, which, as you can see, was not doing too well. And but I think the point here is that there is a recovery, right? The year-on-year for December is a decline, but I think we need to check on this. It may be a concern there, but I think the point here is that on the whole, towards the end of the year, you can, on the whole, you can see sort of positive growth, as opposed to the final number in December. But at least those are the numbers as we have them. Turnover on transport and storage, again, you can see the numbers there. The green bar, strong growth, and accommodation and food service, the turnover on that. Also, you can see there has been significant growth towards in the second, third, and fourth quarters of 2021. Talking about other leading indicators, I think we can look at credit and credit for the sectors. You have that? Yeah, it's coming on up. And here you have credit to manufacturing. Again, you can see the growth has been positive and strong. Trade, transport, and also trade for consumer durables, etc. I think we all understand that a lot of the consumer durables are things related to, consumer durables, but also housing, etc. So that is a good number to look at, and we do look at it carefully. So that's all I wanted to say in terms of the leading indicators. Bottom line, going back to the slide on the growth, you can see we have revised our estimated growth for 2021 to 8%, and we also expect growth to be sustained at 5.9% in 2022. There is one sector, though, that I need to say a word or two about, and this is the agricultural sector. You can see in this chart or in this table the rather flat, or should we say, decline in the sector, small numbers, less 1%, 2%, etc. And I think there are several points here to mention. First is that 2020 was a very good year for agriculture. We mentioned that before. But beyond that, there's also some concern about the numbers. It's true that we did have some less than, let's say, the most favorable weather conditions. So in terms of rain, etc., lack of rain or uneven rainfall in the country, or particularly in the food growing areas. But I think the point here is also this points to some data issues, and we are working with the KNBS and indeed also the Minister of Agriculture that is the principal source of some of those numbers. So we've flagged that, and we wouldn't be surprised if this is revised once better numbers are provided, but this is what they have at this moment. So I then want to say a few things about the MPC surveys that were conducted. I think, as usual, we have three surveys that we conduct. The old one, which used to be the MPC market perception surveys. We also have the hotel survey, and indeed now we also have the CEO survey. I don't want to say too much, but I want to make the point that at least from the market perception survey, you can see that there was significant optimism. I mean, those that were optimistic, the banks that were, let's say, of the respondents of the banks the responding banks, if you look at the level of optimism, this has persisted since November last year. So very optimistic and optimistic. So in total, you have something like 90%. And on the non-bank private sector, you can see also there has been a high level of optimism. You know, there's 63 and also 6% if you add those that were very optimistic and optimistic. So that is one of the conclusions that we got from this. But I think more than that, the next slide comes from the CEO survey. And here we got more information, asking them why are they optimistic. And indeed, they showed that they were optimistic about the prospects of their company and the Kenyan economy. And this related to several factors, and you can see them there. The reduced energy costs and lower inflation, improved consumer demand, which I think we can see in the retail numbers, also in, let's say, Kenyans going on vacation, you know, in the hotels, etc. And indeed, the containment of the COVID-19 pandemic and other factors. But of course, there were concerns that they raised, and I think the concerns there relate to the global economy. The CEOs are quite attuned to the concerns there because, after all, a lot of them are importing things, and they do understand the supply disruptions. Things are taking longer to get to their destinations, etc. And also maybe a wait-and-see attitude by some related to the political calendar that leading, let's say, to the elections later in the year. So those are the things that are there, but the detailed outcomes, results will be published in the next couple of days. Then the hotels. I think this is something that is not surprising. In terms of operation, virtually all the hotels that we surveyed are in operation. And I think that does not mean that every single hotel is in operation. Why is that? Because there are some hotels we know that have closed for other reasons, meaning like they have been sold or they have been put on auction block, whatever it is. So there are other hotels that have those considerations, and those issues ownership issues need to be dealt with. But in terms of the numbers, yes, they're in operation. The occupancy rates have actually been the highest they've been since the onset of the pandemic. And again, as we said last November, the hotels, particularly in the coast, Naivasha, etc., were completely full. And I think these numbers corroborate that. But it is also interesting to note that, particularly in the coast area, you also the hotels obviously do get full occupancy, but at the same time you have the other bed and breakfast sort of operations that surround that actually today are quite widespread in the coast area. And I think there's benefits to them as well, significant benefits to them. So even as we talk about bed occupancy here, we should understand that it's connected to others also that are not surveyed by us, or are not fully captured in the numbers as we publish them. The next one is on hotel or restaurant services. And again, this, as you can see, is going back to the more normal numbers. And I think this is corroborated by everything you see. I want to mention that, yes, we did see the document that was published by, I believe, that was launched by the Cabinet Secretary of Tourism. And I think it collaborates, it relates to the numbers that we've put here. Okay, I want to then move on to other things quickly. First, to mention the inflation numbers, which I hadn't mentioned. This is important, it's part of our scorecard. And you can see that inflation has remained at around 5.7, or rather has come down 5.8, 5.7, and we expect it to remain around there. You can see that the drivers are obviously food and fuel. Now, there is and we at the MPC consider the policy, the government policy on fuel, and in this, it is both on the petroleum fuel and also electricity. And obviously, we assess that those would help anchor inflation or continue to anchor inflation, in a sense, avoid a sort of a run-up in inflation in the medium term, and indeed into the medium term, in the near term, and also into the medium term. Other points to make on banking sector, very briefly, remain stable and resilient. And the only thing to remind ourselves there is credit risk remains high, and will remain high for some time, until we have really dealt with the economy has really has really overcome the pressures from the COVID-19 pandemic, and also the bulk of the economic actors, borrowers, etc., have indeed turned the corner and strengthened their operations. So in the meantime, credit risk could be high, but at the same time, NPLs, non-performing loans as a share of gross loans, has come down to 13.1%. So it's coming down gradually, and we expect this to sort of gradual decline to be continued as the economy strengthens. Again, it is driven by repayments. It's also there's also some write-offs, but the real driver here is repayments and any sort of improvements in terms of the non-performing loans themselves. Of course, at the same time, gross loans, the denominator would increase, and therefore there's a two-direction action here. Finally, the credit growth for the economy, there's a chart on that, has increased to 8.6%. And we expect this again to continue to increase gradually towards 10%, but gradually. We are not predicting a sort of a significant surge in lending. Why? Because credit standards, we want them to remain the same. We don't want a weakening in credit standards going forward. Finally, I wanted to mention that we also looked at fiscal. We don't have that, but I think the point I wanted to make there is that the fiscal performance, particularly on revenues, has been remarkable. We mentioned this in November, but it was confirmed in the December numbers, and we expect that will continue right through to the end of the fiscal year, and something that will remain with us in terms of the framework for tax collection, etc. So that is one of the things that we looked at, and also this in a sense confirms it in a sense anchors the government's economic stimulus program and the strategy that they have, the recovery strategy that has been launched and is indeed being implemented. So this really supports a sort of a positive outcome with regard to those programs that will strengthen the economy. I wanted to stop there, but if there are any questions, we can continue. But I think those are the things I wanted to say. So thank you very much. We have questions.
So thank you. That was the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge, taking us through the thinking at the Monetary Policy Committee. Now, as we usually do, we are taking your questions. And as a reminder, please send this through Slido, SLIDO. The meeting is hashtag MPC0122. We begin with a question from David Herbling. David Herbling from Bloomberg News. David is asking, what is the CBK's strategy on cryptocurrencies? Does Kenya have any plans to roll out a central bank digital currency? If so, what are the timelines? Excuse me. Second question is from Victor Amadala from the Star newspaper. Where is CBK on risk-based loan pricing? Are we likely to see this rolled out this year, and when? And David comes back, David Herbling from Bloomberg News. What is CBK's take on Mwalimu Sacco's plan to voluntarily liquidate Spire Bank?
Thank you. So maybe taking these questions in turn. First, the question about cryptocurrencies and things like that. We've already spoken to the issue of cryptocurrencies, but I think we'll be speaking more let's say, more completely about this space, not just cryptocurrencies. Cryptocurrency is one sliver, one little area. So we'll be speaking more completely about this in the near future, in the medium term, but I guess more in the near term. So please be patient on that. But suffices to say that our position has not changed on any of those products that are out there. On the CBK on risk-based pricing, I think there is a lot of confusion here. And reading the articles that are coming out there, there seems to be a lot of confusion, right? So I think it is important to understand what is going on. We have been working in this space for some time. We've been working in this space in terms of strengthening the framework of that banks use. Indeed, we talked about the new normal back in 2018. And since then, we even put this new, let's say, framework, the banking charter that we talked about, which all banks have signed up to, etc. And it is a direction that relates to various things, including consumer lending, that is the centricity of consumer centricity, and also risk-based pricing. So that is really the framework within which we are operating. Of course, we required banks to sort of redo their business models so as to deliver on this. And so we've been talking to them, meaning they discuss with us what their modeling is and how will they implement it. So yes, they are coming to us and we've talked to them, and like any sort of or specific to our role, we examine, and if they don't show how their homework is done, well, we send them home to come up with explain their workings. I hope, Victor, you understand what I'm saying. You cannot just give us an answer. You need to show your working. I think that is specific. So we've been doing that with all of them, and I think there's no timeline. They need to do it quickly. They need to do it to our satisfaction. So I don't think there's anything to be rolled out. It was rolled out. It was rolled out, and we have to continue working with them Okay. Then on the issue, David Habling is asking about Mwalimu Sacco and Spire. Well, I would ask you to go send that question to the people concerned. This is not a question for me. This is a question if you want to ask Spire, if you want to ask Mwalimu, ask them about their plans. Our view here is always that there has to be we support improvements in the sector, improvements that will strengthen the sector. Part of this is consolidation, mergers. I think you've seen a lot of that. And you've also seen some of our banks expanding beyond our borders, DRC, Tanzania, Uganda, etc. So all that is part of their, let's say, their plan. And I think we, in a sense, if we see that the plans are valid, meaning they deliver as we have explained, obviously we have no problem with those plans.
All right, the second batch of questions. We begin with Razia Khan from Standard Chartered. Growth is firm, but there are still pressures related to the COVID shock. How should we be thinking about monetary policy normalization? What will the trigger be? Duncan Mereri from Reuters has two questions. The first one is, how do you assess the potential risks posed to the 5.9% economic growth this year from the elections and the politics? Duncan's second question, Duncan is from Reuters. When do you expect rates to start to normalize after the dovish stance forced upon policymakers by the pandemic? The final one in this batch from Kefa Moirori of Radio Citizen. Excuse me, with inflation holding steady so far, how long do you feel the MPC can keep its accommodative stance, and what could be the risks to trigger contrary action?
Okay, so most of the questions really, I think three of them are pretty much around Razia Khan's question. So growth is firm, and I think we should appreciate that. It's, I guess we all have been students at one point or other. And when you get 90%, and your teacher says good, yeah? Your parent generally says you can do better. You get 95, your teacher says very good. And your mom or dad will generally say, why didn't you get 98? And so forth. So the point I'm making here is that let's appreciate the work that has gone to actually delivering this performance. The economy as it is, despite the shocks, these are the largest shocks we've ever been tossed, we've ever received, has actually not just landed on its feet, it actually has done remarkably well. So that's the first thing. So I think that first part of growth is firm needs a bit more sort of appreciation. And I want to leave that there. But at the same time, yes, there has been, there are shocks that persist. And I think the point has to be, first and foremost, we have to deal with the health crisis to make sure that it doesn't become an economic crisis. So that approach remains. And in a sense, you don't know where the rocks are if you're sailing, but you don't know where the rocks are. And so you have to maintain this sort of attention and make sure that you don't crash into some reef because in that example, a new variant has come and people have not been vaccinated, etc. This is why the most important thing that we can insist on is vaccinations, accelerating that whole process. But coming back to monetary policy normalization, I would ask you to sort of step back from the, let's say, the prism of the advanced economies. They have a long way to go in terms of normalization. But I think for us, if you remember, the policies that we actually put in place related to, first and foremost, on the lowering the the CRR, right? And this put out a significant amount of liquidity. We lowered it by 1%, if you remember, 1 percentage point. And then also the lowering of interest rate, the indicative rate. So I think the point here is we need to look at everything else. The economy is also changing. This is the one thing that I think we need to appreciate a lot more. The economy today is not where it was a year ago, or for that matter, 2 years ago. And this is why, from our perspective, we have this is why it has been good that we've been pushing on improving our monetary, or modernizing our monetary policy framework. It won't be the same as it was before. And I think the issue now will have to, let's say, recalibrate some of those things. The rules of thumbs that we had before have gone out the window, right? The banks themselves have become much more nimble. So for instance, you've seen the rate of growth of private sector credit, right? 8.6. Now, maybe 8.6 in years ago was kind of nothing. But maybe they are much more efficient in terms of using of credit. So I think the point I'm making is it's hard to say when, because there's all this other work that we need to do, which will, in a sense, tell us when to begin to sort of put a foot on the brake. In a sense, maybe withdrawing whatever monetary policy stimulus that we had put in place. But at the same time, we also need to see where the fiscal policy is. And I think that is an important element that budget. So I know I haven't answered you, I haven't given you a specific trigger, but I think I've given you enough material to show you how we as policymakers are thinking through this material. So Duncan also asked this question: how do you expect the rates to return to normalize really? When? I think I've explained it, so that those two questions are taken together. In terms of political risk, I mentioned it, that there is, we are in an election year, and I don't think the issue of the 5.8 is, 5.8 actually is something that you can say is quite safe. But let me not be very, very, let's say, firm on the 5.8, because we are going to revise it as we get the first full numbers of Q4. That, I think, is the first order of business, getting the first numbers of Q4, which will give us the first set of numbers for 2021. That is from the Kenya National Bureau of Statistics. But I think the only point I would make here is we've seen elections before. We saw them 5 years ago. Actually, we saw a double election 5 years ago. And we saw another one 5 years before that, and et cetera. So I think a lot of this, there's a lot of fear, let's say, in your question. But I think your fear here is more speculative than anything. So I think we would just say that those are scenarios of a baseline, and the baseline is 5.9% growth. Finally, the question about inflation, I guess I talked about that. Kefa's question about accommodative stance, how long can we continue on this, and what would trigger sort of a switching tack, as it were. And I think I've explained it in detail in answering Gracia's question.
All right, the final set of questions from what I can see. The first one is from Churchill Ogutu of IC Asset Managers. Churchill asks, are there timelines to the start of publication of quarterly inflation reports, as alluded to in the CBK white paper, to supplement survey-based inflation measures? Peter Mboro from the Daily Nation. CBK's 2021 Q3 economic review. Kenya's public debt by September was 69% of GDP. Treasury's figure is 64.6% of GDP. What's the actual percentage? Finally, back to Kefa Moirore from Radio Citizen. banks had requested a review on the waiver of charges on transfers between bank accounts and mobile wallets. Are there any updates on that review?
Okay, fine. Maybe beginning with Churchill's question. At this moment, we don't have, we put it out there and we are working on them. I don't think the issue here is to have just to publish stuff, right? We are publishing things so as to ensure that there is better understanding of the issue. And so at this moment, we have indicated in the various, let's say, elements or actions that we want to put out in the, we've indicated it in the white paper. And the sequencing of it is something that obviously we are looking at. Things need to be sequenced correctly. But at this moment, I cannot tell you when is it that we are going to be doing, publishing a particular item or whatever. At this moment, and turning it around, Churchill, at this moment, there's a lot of information that we are putting out there. A lot. On a weekly basis, we are putting out the bulletin. It gives you data. We put it out generally at 4:30 on Friday. Maybe when it slips, it's at 5:30 on Friday, on Fridays. But there are other things that we are putting out. We put out the quarterly numbers every quarter, economic numbers, economic bulletins. But beyond that, there's also other things like the surveys. We are putting out every MPC meeting. We have 3 surveys that we put out. We've put out the diaspora survey. And we've also put out the FinAccess survey, which I wanted to remind you also here. FinAccess, this was in December. And also there was a little, those of you that need a quick sort of summary, there's the FinAccess tracker survey. This is, I think, the 3rd volume. And there are several of them. So I'm making the point that there's a lot of information out there. There's a gentleman by the name Mohammed Hersi, we know him, and he made a point informally that we need to do better, we as a community of, let's say, analysts. He was pointing it, obviously, to analysts that are not in the central bank. He was talking more about the diaspora remittance survey, and sort of begin to get into the weeds in the data that is there, analyzing that, not just getting stuck on the sort of high level one item, that sticks out. He made the point that most journalists picked up the issue that, quote unquote, most of the money is going to MAM, and there are all sorts of articles about that. Not that, that's what the survey showed, but there are many other nuggets in there that deserve good analysis. So Churchill, I think I would encourage you and others. There's a lot of work, there's a lot of bad work as well. We see it. I think you would agree that I have been making the point that there are some analysts who really shouldn't have the label analyst assigned to them, because they have a point of view, and it doesn't matter what the data shows, they want to shock, right? They are shock therapists, as it were. And I think they should go somewhere else. Maybe shock therapy has a place somewhere else, but definitely not what we are doing. So I encourage you to look at all this information. And again, as we have said, we are data-driven, and so we put it out there for a reason. Then there was a question about Peter Mburu on data. I don't know what to tell you, because it's clear. Look at the, don't just look at the ratio, 69%, 64.6%, etc. Look at the numerator and the denominator, right? And then see what the outcome is. The point is that if you begin comparing numbers, first you need to appreciate that the treasury number may very well be a fiscal year number. So fiscal year GDP as opposed to calendar year GDP. And maybe the timeline at a particular point, right? Are you talking end June? Are you talking end September? So those are the realities that we have to sort of be clear about. And I think I would suggest that all those numbers are comparable, or rather they are compatible, all those ratios. If you would only pull up the denominator and the numerator, and then you'll see what it is. In terms of the numbers that we are putting out on our bulletin, they are quite clear in terms of if the US dollar value of it, or the Kenya shilling value of it, or whatever else. And so you should be able to calculate it and confirm what we show there is actually correct. KEFAS, banks, I don't know about this had requested. So if they talk to you, that is okay. I have a lot of trouble when people are talking to other people. And yeah, I don't know. I don't know what this is. So I just want to leave it with you, Kefa, because, you know, at the end of the day, we have to do what we have to do. And so if they have requested, I don't know. I leave it there. So Kefa, I would only say, if you live in Kenya, you know that Stella will come back. Even if it takes years, you know that. However, until Stella tells her side of the story, Freshly Wamburi is just playing the victim.
On that musical note, that brings us right to the end of our press briefing for today. This is a post-MPC press briefing for January 2022. And as usual, as it says in the press release for the MPC, the expectation is that the MPC will meet in March, but obviously stands ready to meet at any other time. So for now, thank you very much for joining us, and do have yourselves a good afternoon.